pop that poll in the chat now. And please do just take a moment to click on the option that will tell us a little bit more about where you are at in assessing the financial impacts relating to climate change and the disclosures from that. You'll see there are 5 options there. That one, you might ask a question whether you're in the right place, and the other end of the spectrum, you've already got it done and you're looking to improve, and we're hoping you might share some thoughts with us today. So I'll give you a moment to click the option that best suits your position. Let's see what we get through coming from that. Oh, here we go. Lots of people beginning, but not yet onto the quantification. Some people have started the quantification, which is slightly misspelt there as a word I can't pronounce. And others are just holding off for the moment with the opportunity that's been afforded. Okay.
Simon,
yes.
Can you hear me? Sorry.
Yes.
I just want to acknowledge there's been a few technical issues with people joining, so I just thought we'd just pause briefly. Some people are still waiting to get in. I think we continue, but I just wanted to acknowledge we're people working in the background to resolve that. So
yeah, thank you. Well, we're very grateful to have Katie with us today, and Molly, our technical support team. So Katie, just give me a shout or a message if you need any support there. We've got, how many people have we had vote there? 50 responses, which is pretty good out of a total of it's not telling me. Okay, but look, let's crack on. Time is limited, as we said. I'm going to hand over to Ian Edwards now. He's going to talk to us about the challenge involved in this work, the nature of climate-related risks, and the immaturity currently of the tools and data. And then he'll move on to cover some of the basics of the disclosures, including the objectives of those, the requirements, and what you need to be disclosing. And then we'll pause for some questions. So please pop your questions in the chat as we go along. I'll hand over to you, Ian. Thank you for joining us.
Yeah, thanks, Simon. And yeah, look, what I'd like to do is I'd like to run you through some concepts, challenges, and back to basics, as Simon's mentioned, and things that you may want to consider that can help you frame how to report financial impacts associated with climate related impacts. So I'm sort of setting the scene, if you like. So the first thing, when we talk about the challenges, thanks James, is we're operating in an environment of deep uncertainty. So deep uncertainty is characterized by futures that are equally plausible, and it's the reason that we use scenario analysis, as we've got no way to confidently apply traditional risk techniques that utilize probability and consequence. And deep uncertainty is driven by the sheer pervasiveness and complexity of climate drivers, that can arise, due to interdependencies between and within, natural and socio-economic worlds. And they can create this potential for non-linear change. So it makes it virtually impossible to establish the timing and magnitude of future impacts with any real degree of certainty. And what I'm showing on the slide there is, it's actually a slide from the NGFS, and it sort of pretty well breaks down the factors that I've just sort of spoken about that all sort of drive deep uncertainty. But the point is, we're working in that environment. So if we go to the next one, please, James. The other thing is, look, we're working in deep uncertainty. We've got tools that we can apply to the likes of deep uncertainty. As I mentioned before, one is scenario analysis, but we're really constrained around the data that we've actually got available to us. And what I've put up on the screen here is 3 reports, and I'm using scenarios as an illustration. And these 3 reports are highly critical of the likes of the big integrated assessment models that look to integrate climate hazards and socio and economic impacts. And essentially what they're saying is, look, beware of single numbers, because although scenarios are a great tool, if you utilize them to quantify information, just be aware of their constraints and limitations. And explicitly, the criticism here is that, specific to the NGFS and any of the big scenarios, we could apply to any scenario analysis you're doing yourself. is typically they'll only cover a minor subset of hazards. And there are concerns that the damage curves that are applied to estimate the economic impacts by these big global scenarios significantly underestimate, in particular, physical risks. So the data ain't great, but we've still got to think about and come up with what we think these impacts are. And then there's a third challenge. We go to the next slide, please, James. And that is, quite simply that it's all new. And as the XRB articulate here, this is a relatively new area of disclosure globally with little precedent available to draw from. So that has two implications. The first implication is that the guidance is also relatively immature. It's sort of working this out every bit as much as the rest of us. And the second implication is there's quite a small sample, if any, of reports that we can go to look and say, well, oh, that's how you do it. Maybe we can sort of take that approach. So in other words, it's very much a journey of exploration. So just to the next slide, and I'll close this out because I want to move on to other things. 3 challenges we face. We face basically the nature of climate-related risks. We face the fact that because of the nature of climate-related risks, data is invariably quite immature. And the third thing is we're in a new space. So look, if I can hand it back to you to Simon, take it from there. Thanks, mate.
Ian, are you just going to carry on and cover the challenge and then we pause for questions?
That is a challenge, Simon. I've just summarised the challenges.
Sorry, I beg your pardon. They're going back to basics.
Oh, okay. Yeah. Look, I can take you through the
and
back
then
to
we'll
basics.
Pause for questions after that.
Yeah. No worries. Sorry, mate. Okay, look. So in a situation like this, and as I say, I'm here to frame how you might address this particular issue. Is I always go back. Personally, I go back to basics, and I ask 2 questions. The first question is, why am I doing this? And the second question is, well, what am I actually required to do? I sort of go back and I reconsider that element. So look, into the first question of why. Next slide, please, James. We don't have to go far to find out what the objective of this whole disclosure regime is. It's articulated in the first 2 paragraphs of the XRB CS1. And it's up on the screen there. I'm not going to reread it, but if you flip it, what it essentially means is the hidden agenda, if you like, that I would assert, and I think it's in these objectives, is to motivate entities, companies, whatever, to actually build their resilience to climate-related risks and opportunities. The other thing is, the second thing is, it's all about disclosing that journey towards resilience. And in that regard, it's disclosing, what you've assessed as your risks and opportunities and how you'll not only address those risks and opportunities, but actually how you'll improve your assessment process over time. Because as crazy as it sounds, the actual assessment is actually an indication of your understanding of climate-related issues. So it's quite telling to your audience in itself. So we've got someone laughing. If anyone could go on mute, that'd be much appreciated. Thanks. So that's the objective of why, if you like. The next question is, what are we actually required to do? So we go to the next slide, please, James. A good starting point is actually go back to the principles of disclosure. And these principles on the screen I've drawn from the CS3. And there's two sets of principles. One is related to the information that we're compiling. And the second is to how we present that information in the reports. Now, I don't want to go through each of these principles, but I just want to draw your attention to a couple because I think they're quite important. The first one is the information and accuracy. Now, there's recognition in the standards that much of the climate disclosures are going to be judgment calls and estimates. Now, what this implies, it implies that to be accurate, you need to disclose in some way the uncertainty and the limitations in the numbers, the assertions, or whatever you have come up with. So you could actually argue accuracy is not about a single figure. In fact, to report a single figure as a financial impact, for example, may actually give the confidence, may give an impression of confidence when actually there is none. And this would actually constitute a misstatement. It's more about reflecting the uncertainty and the nature of your disclosure. And the second one there, of course, I think is quite important, is that verifiability. And that really is ensuring that you've got a full audit trail to support whatever disclosure you've come up with. And on the presentation side, all of those principles there, basically, they combine to meet the objectives that I mentioned before, i.e. to enable primary users to assess the merits of how you are exposed and ultimately what you're doing about it. But the one I want to draw your attention to is that principle of coherence. And really that's the relationship between the climate report and any other reports that you may publish, in particular your financial accounts. So these are important principles to consider as you frame how you're going to report your financial impacts. But look, diving into the financial impacts themselves, James, we just go to the next slide. I'd like to start with current impacts. And of course, a good starting point is, what is a current impact? And it's essentially a risk or an opportunity that's crystallised. As articulated by the XRB, impacts have moved from being a risk or opportunity to something that has occurred. Now, that's important because it's an impact in your current financial reporting period. Therefore, it could actually have implications, not only for your climate statement, but for your financial statements. So we go to the next slide, please, James. Now, Simon mentioned, look, I'm a chartered accountant. Actually, it's not 20 years I've been a chartered accountant, it's over 30 years. But I sort of know what I don't know. I'm very conscious of that. And I am not a financial accountant. So I'm going to talk about a few concepts right now. And I think I think I'm on the money with the concepts. But if there are any accountants out there, and if I've misconstrued anything, please feel free to put it in the chat, or let's discuss it later. I think the principles are the most important element here. The first thing is if we duck back to the TCFD with this particular quote, historical and current period climate-related financial impacts such as write-downs of obsolete inventories are calculated and reported according to the financial reporting standards. So in other words, where there is a current impact, the other thing that needs to be considered is, should that impact be recognised in some way via the accounting standards in either your balance sheet or your P&L. And the two reports that I've put up on the screen, and we can send a link to these later if people haven't seen them, I think are really, really good, provide really excellent explanations of the relationship between the accounting standards and financial climate impacts, especially the one on the right there, which was developed by the CPAs back in 2021. So that can give you a deeper dive into what I'm talking about. But what I will do is I'm just going to take you quickly through 4 examples of how this might crystallise in both your financial statements and your climate statement. So if we go to the next slide, please, James. So I just want to quickly run you through 4 examples here. The first one is you've developed a new certification service for contracted supply chain partners to verify their own farm climate resilience practice. From my perspective, I would actually capitalise that as an asset on the financial statements, because you've developed essentially something that's going to provide you a revenue stream into the future. So that would be incorporated in your balance sheet. But by the same token, over on your climate statement, it would be of material interest to your primary users, because here you are expanding your business because of climate change. So in your climate statement, you may have an explanation and provide a little bit of colour around why you did that. And you may even consider providing some sort of projections around what that revenue stream may look like. And of course, you would want to draw a distinct link between the explanation in the climate statement and where this has been recognised in your financial statements. The next one is access to capital. So you've developed a climate-related risk disclosure to gain access to European capital markets. Now, depending on the magnitude, you may just expense the monies that have gone in to doing that in your P&L. But over in your climate statement, once again, you may want to point to your financial statement and say, look, we have been doing this. We've taken this action because we're looking to expand our access to capital markets. But you may want to go a step further. For example, if you have been able to access a lower cost of capital, you may want to talk about that and even quantify, what the difference between the cost of capital you can access via these new European capital markets is compared to what you were traditionally accessing. The next one is buildings, really straightforward. Repairs required after damage from cyclonic winds, straight to your P&L. Now, that is something else you may want to discuss in your climate statement, but I think the important point here is there is no requirement at this point in time from the standards to attribute a degree of that damage to either natural variation, which has driven the cyclone, or that which has been driven by anthropogenic climate change. Attribution science is advancing very, very quickly, but there's no real need to sort of break that down. It's more about the fact, look, we've been hit by this climatic event. And the last one, I think this is interesting because this to me is something that may not be recognised explicitly in your financial statement, but you may want to talk about in your climate statement. And that is flooding at supplier's warehouse resulted in 2 weeks delay in supply, meaning that we're unable to meet consumer demand, i.e. we've lost 2 weeks of revenue. Now that'll be implicitly incorporated in your P&L because your revenue may be subdued to an extent. But in your climate statement, you may want to sort of talk about that in far more detail. And you may even want to consider disclosing the likes of how much revenue you think you may have lost. You may do that by, typical revenue sales across a 2-week period at that particular point in time of the year. So these are all examples of relationships between financial impacts that can appear both in your climate statement and in your financial statement, or potentially in the climate statement, but not in the financial statement. So look, if we could go to the next slide, please, James. I want to just quickly talk about anticipated financial impacts. And of course, anticipated financial impacts are expected to occur in the future. But I want to focus on one phrase here, and that's this reasonably expected. So if we could just go to the next slide, please, James. And I'm going to be frank with you. How reasonably expected is to be interpreted, I'm not 100% sure at this particular point in time. There are many interpretations of reasonableness in law, reasonable man, for example, and to a lesser extent in the accounting standards, when looking at contingent liabilities or assets, you've got this concept of reasonably plausible. But I'd like to start by going back to the TCFD, which has given rise to all of these disclosure requirements all over the world. They note that it is important to note that forward-looking disclosures are intended to provide a view of an organisation's range of plausible risks and opportunities in a variety of future business contexts, not a prediction of outcomes. Now, the operative word there for me is plausible. And this makes me think about, okay, to what degree could we utilise the outcome of our scenario analysis? Well, I would assert that depends on how you've developed your scenarios and what your scenario outcomes look like. Because if you go to the 12-point checklist of what makes a quality scenario, which is provided by the XRB and their scenario staff guidance, plausible is certainly one element, but another element is challenging. So, for example, when Don and I develop scenarios, and we do a lot of this work, challenging is a really important element. And challenging is not necessarily reasonable. So, for example, if we're looking at an ensemble of modelling results of coastal hazards, we'll tend to go for the 99th percentile as opposed to the median. So I think you've got to be a little bit careful here, in respect to what that impact may look like and whether it is reasonable. As I say, I'm not 100% sure of the answers at the moment. I don't think it really matters, to be honest, because as I'll discuss in a second, the most important thing is transparency, 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 but it's just something to consider. So to the next slide, if it's okay, please, James. So there's two more considerations that I want to bring to your attention, and they're both discussed in the XRB staff guidance. And the first is the XRB assert, and I would agree 100%, that it's not necessary to be precise to be relevant. And I think this has complete relevance to the accuracy that I was discussing before. And in many circumstances, it actually makes sense to remain at a high level. So what this means is this paragraph at the top is ultimately the financial impacts will be, certainly the anticipated financial impacts will be a judgment call. In that judgment, it's really important that you justify how you've come to that judgment, but it's also important that you incorporate the degree of uncertainty in that judgment, i.e. how confident you are. So the less confident you are, for example, the more you may utilise ranges, for example, or even just articulate your financial impact in textual terms as opposed to quantification. And the next one is this paragraph that notes that the entity should disclose the anticipated financial impacts of its climate-related risks and opportunities if no action is undertaken. So in other words, what this is requiring is that you disclose the impacts prior to any anticipated mitigation action. Now, James wanted me to talk about insurance because apparently I think insurance has arisen in the past, and whether you could look at the impacts after insurance has been triggered. And look, I mean, it's your call, but from my perspective, I would certainly argue that that would not be a good idea. And that's because, well, the first thing is, in the academic world, there is an absolute plethora of reports and journals that talks about the existential risk that climate change presents to the insurance sector. But the thing is, with insurance, premiums are typically written every year, and insurance that may be affordable this year may not be affordable next year. So in other words, I draw out these two concepts of permanence and presence. Insurance, I would argue, is not, it may be present, but it is not permanent in the future. And there's no way that we can say that it is. So I think it'd be far more prudent to report the implications of insurance after you've considered the gross impact of a particular event. So look, just bringing it all together. Let me just go to the next slide, please, James. Specifically for anticipated impacts, the form of the impact or the way that it's disclosed should reflect the level of uncertainty. Gross to net is more informative. Consider permanence and presence, but the most important thing is be transparent and justify what you come up with. So sorry, Simon, that's it from me, mate. If I can hand it back to you, that's okay.
But no, don't apologise. That was fantastic. Thank you very much indeed, Ian. And we've got a few good questions. Let's see if we can get through those quite quickly because time has escaped us a little bit with the technical challenges today. One I think you picked up, which was from Carl, about because of the uncertainty, actually, being able to talk in ranges rather than specific numbers in terms of the financial impacts. And I think you picked that up. Is that correct, Ian? Talked about that?
Yeah, I'd say so. And I mean, look, if it's really uncertain, as I say, take a qualitative approach,
Yeah. So the next question is, well, given requirement 15B, given it could be read in two ways, are you saying it's the reasonably expected anticipated impacts of the risks and opportunities as opposed to the anticipated impacts of the reasonably expected risks and opportunities? Complicated question, but I think you get what it means.
Yeah, I get what you mean. That's actually a really good question. I'm just going back and looking at it now. The anticipated impacts of climate-related risks reasonably expected by an entity. Look, I think there's two things. When you look at both paragraph 12 and paragraph 15, the starting point is the impact itself, right? And then essentially it's then asking what are the financial implications of the impact. The way I've always interpreted this, but I'm up for discussion 100%, is you've identified your risks and opportunities. Okay, what are the reasonably expected impacts of those risks and opportunities? Does that answer your question? Sorry, that's...
It gives your view on it. I'm wondering if Emma's a lawyer, but it certainly looks like a sort of legal interpretation of the risk of the wording there. But a really good question. Thank you for that, Emma.
I mean, at the end of the day, you know, when you as you embark on this journey, one of the first things you really should be doing is a risk assessment. So you're identifying all of your risks, and then you are assessing those risks. So I would consider it as part of the outcomes of that assessment to have an idea of what is reasonably expected. So that's, I'm coming from a process perspective.
You got a smiley face back from Emma, so I think you've got that one nailed. Just fine. Let's just answer this last question quickly before we move on. How do you marry up the guidance around not needing to be precise with the definition of financial impact as impacts on financial position, financial performance, and cash flows? That distinction between precision and then financial information, essentially.
Yeah, well, look, I mean, I think that goes back to what I was saying. And it's sort of, if we go back to that second last paragraph that I provided from the XRB around, I'm just looking for it now. You know, it's important that preparers bear in mind that this information need not be precise to be relevant. You know, and going back to that, the way that accuracy is actually recognised in the standards, that precision in many circumstances can create an impression of false confidence. So it can actually be represent a misstatement. And you know, if I go back to, you know, I provided the criticisms around the likes of the NGF scenarios that have been raised by the likes of the Institute of UK Actuaries, University of Exeter, so on and so forth. One of the main criticisms is that those scenarios give an impression of preciseness and confidence where it simply does not exist. So I don't think precision is a particularly, I mean, if you can be precise, fantastic. But the most important thing is to disclose the nature of the impact and somehow get across the uncertainty of that nature in your disclosure. And that's not necessarily, I mean, you can use precise wording, but it's not necessarily a pinpoint precision quantification. In fact, I would argue in the space we operate in deep uncertainty, current impacts, that's something different, but anticipated, I mean, that simply doesn't exist.
Thank you, that's great. Thank you very much. Let's keep moving. We can pick up any further questions at the end once we've had the full picture. I'm going to hand over to James first, who's going to cover the general approach and considerations for undertaking a financial quantification exercise, and then he'll pass on to Emma, who will dive a little deeper into some of those quantification calculation methodologies. So, James, over to you.
Thanks, Simon, and thanks, Ian, for that context and sort of establishing those questions early on. We're going to dive in now into some approaches that we think are useful and practical in terms of assessing financial quantification, and just want to start with some key considerations. So Emma, if you could just put those all on screen, that'd be great. First up is very simply leverage the existing knowledge you've gained through the previous work, whether that's your scenario assessments or your risk and opportunity assessments. As Ian has said, be really clear on the limitations, both relating to the data that might be available, but also the methodologies, and we're going to go into that a little bit more, and consider how those might be able to be improved over time. Number 3, starting simple and building maturity, and importantly, the approach that you take or a particular organisation takes will be unique to their context and their particular organisation. So there are a range of approaches, but again, the choice will be unique to your situation. And lastly, capturing all the assumptions and documenting those clearly is really important. Next slide, please. So some language we're going to use as we go through relates to this slide. On the left, you've got your core transition and physical risks, and those can propagate through an economy or through a business at the micro level at the top of this slide, and the macro level, which is at the bottom. And what we mean by that, for example, at the macro level, that could be impacts on GDP, changes in prices, changes in productivity, changes in employment and labor, etc. So the macro economy impacts are one level, and at the micro level, those are those impacts on your business, whether that's direct damage, that's market changes, change in technology, etc. And those propagate into your the financial implications and into your financial statements. So we want to introduce that language of micro and macro, and we'll come back to that. So just a reminder that the requirements of the strategy disclosure include a description of our current climate-related impacts, description of the scenario analysis, the climate-related risks and opportunities, the anticipated impacts of those risks and opportunities, and a description of how an organization will position itself as the global and domestic economy transitions. So how do these things link together, I think, is an important consideration. So we've just put a little diagram together, which draws on what Ian has been saying as well. So we're starting with our scenarios and our risks and opportunities, and we want to make sure there's continuity of how that feeds into impacts, your financial impacts, and ultimately your strategic response or your transition plan. So there's a review element at the start. The middle piece around impacts and financial impacts is what we're talking about today. And the transition plan, for those of you who dialed into the previous webinar, we spoke in detail about what a good transition plan might consist of. Next slide, please. So going a bit further into detail, we want to set out a process here. So very quickly, we've got 6 steps. So number 1, identify and review your material risks and opportunities. Number 2 is identify what types of impacts and financial impacts might arise. And a way to think about that is by using impact pathways. And we're going to talk about that shortly. Really cool, a really useful tool. Then develop some impact descriptions and effectively a logic model to how those might interact, and select the impacts that you think you can quantify. Start qualitatively and build into quantification as you move forward. Then decide the quantification method and collect the relevant data sets and an appropriate approach to quantification. And obviously the data sources and assumptions are going to be key for that as well. And that's going to vary depending on your sector. Then finally, undertake the financial impact assessment and the disclosure piece as well. Next slide, please. So let's talk about these financial impact pathways. So this is effectively how a risk can propagate through the into financial impacts and your financial impact statement. Core to this diagram on the left-hand side is, in this example, the risk and opportunity in this case is a flood hazard that might impact on a property portfolio. There's a direct impact, which we've listed here as flooding and damage to the property, but then there's this range of indirect business impacts, and those are illustrated in a column, but they could be cascading and one could lead to another. So what this impact pathways is simply saying is identify the range of potential categories of impact that could be relevant to you. So in this case, we've got direct damage to a property, we've got reduction in rental leases, we've got revision of asset life and property values, and increase in insurance or loss of insurance. And down the bottom there, we want to make the point, and this is probably why we're hosting this webinar with Ian and Donovan, is that on the left, you've got specific expertise relating to hazards and impacts, but you also need to involve expertise either internally or externally around cost estimation, financial modeling. So again, these two areas can come nicely together. Next slide, please. So now we want to quickly talk about the difference between what might be a high-level assessment, and we've called this an exposure assessment, versus a detailed assessment. So an exposure assessment might relate to specific climate risks identified, physical or transition, and there are various approaches which we'll go into around the detailed assessment. The exposure assessment might look at the percentage or dollar values exposed to a given physical hazard, let's say a flood event. So your total portfolio of assets that might be exposed to a 1 in 100-year floodplain under a given climate scenario. So that's relatively easy to technically develop and from a physical risk perspective. And you might look at that under your different scenarios that you've developed. So you'll have a different level of exposure, and this is the aggregate exposure in that entire circle under those different scenarios. So that could be, as I've just mentioned, related to a physical hazard, or in a transition sense, if, say, for example, you were a port and you were exporting to, you had a dairy part of your business and a forestry part, you could look at what percentage of your business might be exposed to those sectors. So it's a very high level number. I wouldn't class it as a financial impact, but it is an exposure metric. So that's exposure. If we then go to the next slide and say, well, how might we dive deeper into that exposure and say, well, what part of that exposure could result in a specific financial impact? That's going to be a proportion of that aggregate exposure. And there are ways to do this. So, for example, if we talk about the physical example, that could be an average annual loss assessment for flooding in relation to your physical assets. That could be also coastal inundation or other physical hazards that you could get the data for. Emma's going to talk more about that shortly. And again, in the transition side, that could be the range of plausible impacts relating again to those sectors that you might export into if you're a port or you're a business that exports, based on a series of assumptions. And we're going to talk about that, and we're calling that a scenario-based or deterministic assessment. So just that difference between the high-level exposure versus a detailed assessment, I think, is important. So we're going to talk very briefly about, going back to what I introduced earlier, a macro level assessment. I'm only going to touch on that briefly, versus some forms of these micro assessments. So Emma's going to talk about a probabilistic an approach and also a deterministic. Before I hand to her, I just want to touch briefly on this macro context that relates to GDP, interest rates, employment, etc. So there's a lot written about that, and people on this call will be familiar with the NGFS. They'll be familiar with work done in New Zealand by the Treasury and others. I think this slide is useful from the New Zealand Treasury. It just sets out the categories of potential macro impacts that could relate to the supply and the demand side. So it talks about, on the supply side, climate impacts on labour, on capital stock, broader infrastructure impacts that might propagate technology and trade, and on the demand side, impacts on consumption, investment and trade as well. So a useful resource here. We're not going to go into any more detail on the macro side, but I think it's important to recognise that for some sectors, this will be important. It's very difficult and complex, but we'll move on. So Emma, I think I'm handing to you now to lead us through those two examples of probabilistic and deterministic, and pass to you.
Yeah, thanks, James. Yeah, loud if I've go on mute or any other technical difficulties, but hopefully we're good from here on out. So yeah, briefly touching on some probabilistic modelling. So this method really involves modelling and statistical techniques to estimate the potential distribution of losses by modelling losses for many independent events. And data requirements for this type of approach is heavy. So you will need information such as geospatial data sets, hazard characteristics regarding its severity, return period, damage functions, and asset values as well. So damage functions are the calculations of the probability of damage based on asset vulnerability and hazard severity. So that interaction between the hazard and a built structure. So probabilistic loss modelling approaches are really used to obtain a more refined estimate of hazard frequencies and related damages, and provides outputs such as average annual losses, under given scenarios or probable maximum losses for different return period events. And as mentioned, this type of approach is really useful for the assessment of direct damages to things like property portfolios from acute physical hazards such as the flood, coastal inundation, etc. So this is a technique that's widely used in the insurance space to understand the likely risks that you have to your asset set and the need for insurance coverage for that. So working out your premiums, your limits and deductibles, etc. However, it's really important to understand the methods of any probabilistic modelling that you use and the uncertainties that come with that. You also need to understand how to interpret and use the results as well. So the level of uncertainty is directly linked to the quality of data, and the outputs of models should be considered as indicators of the order of magnitude of the risk and therefore the financial impact from that, not exact values. So again, it's just taking these types of assessments as a guide, a range of what is potentially the impact, but really noting the limitations and the uncertainties around this type of modelling. But just flagging that TNT have some really great expertise in the natural hazard space for the physical climate risks, including some modelling capabilities. So if acute physical hazards is still a real gap for you with regards to climate-related financial disclosures, then do please get in touch. The team will be super happy to support you better understand your risk in that context. All right, just moving on. So it was just a diagram to kind of just explain the probabilistic modelling approach just a little bit more. So you have your hazard, which often has modelled event sets up to 10,000 simulations, which are often calibrated with historical events. And there's discussions whether you can take those traditional catastrophe loss modellings and apply climate change influences on those to forecast losses out into the future under different scenarios. Then you also would require a lot of exposure information for your portfolio of assets, where they are geospatially, asset attribute information such as building type, construction type, age, floor level, roof types, and also the asset values as well, whether you're interested in insured loss or replacement costs. And then you would run through damage estimates and vulnerability curves as well to get then your loss from that assessment. But in reality, considering the uncertainty of anticipated climate-related, the impacts of anticipated climate-related risks and opportunities, the most pragmatic approach would be to quantify your financial impacts through a more of a deterministic assessment or a scenario-based approach. So this is taking your scenario information or any other information that you've got that you use to identify your risks and the impacts from those risks, and creating some more granularity around those scenario assumptions to enable you to come up with a quantification. So you would start with looking at a material impact, for example, a reduction in demand for a current product due to a new low carbon alternative. You'd probably do some research around published sectorial studies, previous events, customer views, and come up with a market exposure or the percent of revenue from the sector that is likely to be impacted or you might lose out from. And then agree some plausible reductions under different scenarios. So using your different scenarios and the assumptions around that plausible future, what are some of the factors that you can glean from to come up with some plausible reductions in that demand? Then you'd estimate a range of financial impacts from that and include those in your financial models.
Just got about 3 minutes left, Emma. If we can, want to make sure we leave some time for some Q&As.
Awesome. I'll speed through this then. Thanks, Simon. So just quickly, sources of data and assumptions. As James mentioned, it depends on the context of your organization, whether you are really exposed, are a greenhouse gas intensive sector, then you may be able to get information from those published predictions. Looking at carbon price, forest stress stats, and or EV uptakes may be really useful for you to be able to calculate your financial impacts. Where on the other side, if that's not the case, then you really need to look at something a bit more bespoke. So develop that more granular assumptions across different scenarios as well. And we may not have a lot of time for this, Simon, but I just wanted to revisit the financial impact pathway that James walked through and just take one of those impacts and see how we could go from that impact to coming up with a bit of a quantification around that. So first up, you would determine your method for quantification. So in this case, we are looking at a reduction in rent income due to flood-affected properties, and a potential calculation method is simply just income times the duration of that outage. So some information that you would need would be the number of properties that would be impacted, the duration and the frequency of the flood events that could cause the disruption, and the rental income values as well. So taking on that scenario approach or that deterministic approach, you would come up with your scenario assumptions for your 3 scenarios or your 4 scenarios or however many scenarios that you have come up with for your organization. You would also look at the time horizons that you would want to assess this financial impact for. You may only be looking at the medium term, or you may want to look out to the long term as well. And then based on the information and the assumptions, you could come up with a real high level way of quantifying this by understanding how the exposure of your property portfolio may change over time under different scenarios. Therefore, the number of properties impacted may change, and also the number or duration of disruption events in a given year may also change. So here is just a real crude way of showing how those assumptions can come into play with providing a real high level range of what your financial impact may be across those different scenarios and timeframes. So in closing, I just wanted to put a couple of things up here with regards to disclosing this information. So quickly, you would want to first have that qualitative description of the gross risk and its impacts. You then can quantify what you are able to, present those values as ranges and account for uncertainty, highlight the time horizons that these impacts can occur in, and also if these impacts do show up on your financial statement, make sure that you link that from your climate statement. Add any additional information regarding actions to reduce or avoid the risk and link to your transition plan. Really make sure that you are transparent and include your methods, assumptions, limitations, and justifications as to the information that you used and the methods that you used for quantification. And lastly, if you're unable to disclose any quantitative information, you have to include an explanation of why, and it would be also really good to include the steps that you are taking to ensure that you'll be able to quantify in the future. So that's it, Simon. I'll hand back to yourself and we can dive into a bit of a discussion. I'll just leave the main closing points up that people can take.
Thank you. We haven't got a huge amount of time for discussion, and look, technical issues have taken a bit of time away from us today. What I thought I'd do, and I know James has been very helpful answering questions in the chat, but we've got Donovan here, and to make the most of the expertise, Donovan, you addressed a couple of questions in there around some of the issues around tipping points and other things. Just given I'm sure you've been looking at the chat, in sort of 30 seconds or more, what would you add to this discussion, or what advice would you be giving people in terms of thinking through some of the things they're most concerned about?
Yeah, thanks for that. Tipping points are a tough one. I think it's important to recognize that there are some things that we just can't quantify. That there are questions that people are wanting answers to, like fat tails of some climate risk models. For some climate variables, we just don't know. There's not enough science around to understand, like, when is a storm going to hit in a certain area. So my take-home point there is that there's a lot of unknowns, and it comes all the way back to those points that Ian made around the nature of climate risk. It's really, really complex. It's hard. So that transparency is really important. And one thing that we haven't seen in a lot of the climate disclosures to date is that verifiability, where people need to show their workings, show how you are coming to your decisions.
Thank you, Donovan. That's great advice. Thank you very much. And there's one question here that we haven't picked up from Jessica Roger. James, I think this one was for you. How do you see the interplay between the financial impact quantification and then cross-industry metrics around the percentages or amount of business activities or assets that are vulnerable to risks?
Yeah, I was actually just typing away there. So I think there's a really strong link between the metrics and some of the financial methodologies, particularly in what we were talking about in terms of exposure. If you can measure your exposure, is, in my opinion, far more easy to come up with a number that you can have a bit more confidence over, I suppose, in terms of the extent of the exposure, and something that you could repeat on a regular basis to track. So if you're saying, for example, the number of buildings or assets within a particular flood zone, or the percentage of revenue towards a certain sector, while that isn't a financial impact per se, it's still a very useful metric that you could track over time. So I do believe there's a really strong link here between the metrics and some of what we've presented today.
Fantastic. Thank you, James. So it's all we've got time for. But before we go, we're going to have a cup of Mad Tea, which is a really cool little teams game that we do. What I'm going to ask everybody to do is to type into the chat box two things. One word of feedback on the session today, whether you got enough, not enough, great, whatever it might be. And the second thing I'd like you to type in is, what would you like to dive more deeply into if there were a follow-on session in this area of climate financial quantification? And then don't push go yet. We'll all push go at the same time, and that's why it gets mad. So I'm going to invite you to, while you're typing that, before you push go, I'm just going to say a big thanks to the team here, James, Emma, Donovan, Ian. Big thanks to the team behind the scenes, Kate and Molly. You've had a stressful time, or slightly more stressful time today. Big thanks for you for making the time to join these sessions. And as I say, keep your eyes peeled. We are going to run some more deeper dive sessions next year. We're particularly looking at more practical examples. So here we're 1 o'clock, time to press go. Let's see how many people can give us a response on how they found today and what they would like to hear more of. But other than that, thank you. Kia ora. Have a wonderful afternoon. Thanks for your patience today.